More names in a bit. Gautam Trivedi is with us, managing partner at Nepean Capital. Gautam, good morning. Great to have you with us here. Usually we have you here in the studios. I guess it's the rain.
It's the rain. I was hoping to make it to the studio, but I guess you guys are brave enough to get to venture out today.
We had to send a couple of rescue teams, Gautam, to get people into office.
Floats and all outside. Good call, Gautam, of not coming in. We can tell you that. Good call. Today, technology works, and let's make use of it.
Absolutely.
Exactly.
Gautam, so let's just start with a bigger talking point, and we'll drill down to individual stuff, right? 20% underperformance. India is up 1% in dollar terms this year. The MSCI Asia ex Japan is up 21%. This year, YTD. Of course, it's. I guess what happened before over 21, 22, 23, etc. wouldn't matter. But how do you look at this, Gautam? Is there, people look at the numbers like this and say, well, maybe at some point it'll turn in a very, very rapid and ferocious way. Is that the way to look at it? Or you think, maybe the underperformance stops, but you got to have real solid reasons for the market to go back into up and up kind of a phase?
Yeah, I think the way to look at this is that unlike domestic Indian investors, retail investors, FPIs have a choice of where to invest, not just within emerging markets, but it could be whether to invest overseas at all or not. And I mean overseas ex the United States, because that's where bulk of the money comes from into EMs. Even if it's routed via Singapore, routed via London, a lot of the money, of course, does emanate from the United States. So when I look at that, and if I look at India in that context, we had basically two issues: high valuations. But again, that was never a big deal because we had earnings that were growing at a pretty steady double-digit clip. But now we have an earnings slowdown. So if you look at the earnings situation back in the States, first quarter of this year, the S&P 500 posted a 12% earnings growth in EPS. So EPS growth of 12% for the S&P 500. Now you might ask me, wait a minute, but the Max 7, what about them? Aren't they contributing most of it? Yes, 28% earnings growth for the Max 7, but the balance 493 companies posted a whopping 9% earnings growth. That's even higher than the year, and that's a $30 trillion economy. Now, the second quarter of this year, the S&P 500 posted 11% earnings growth. So if you've got strong earnings growth in your home market, of course, that may slow going into the third quarter. But if that's the kind of intensity of earnings that you have back home, you think twice about potentially putting money into emerging markets with all the political risk, currency risk, and other issues. So I think from an India perspective, and more pointedly to your question, FPIs need to see earnings growth come back. And if that doesn't come back, I suspect they would continue to sell. We've seen roughly about $16 billion of selling year to date. But if I look at it over the last 12 months, it's $28 billion. So India suffered the highest in terms of FPI selling across all emerging markets.
But Gautam, sorry, allow me to come in over here, but that's exactly the point, right? We know that it's earnings, which is the missing piece, which is why FPIs are going, elsewhere, wherever they're getting better earnings and better valuations. But that's the point. What is the kind of earnings pickup? Because we've got the RBI cuts, we've got the income tax cuts, we've got the GST cuts. So now what is the kind of earnings pickup that you are estimating? I asked the same question to Vetri Subramaniam last week on the show, and he was actually not expecting a very big bump up, a huge surge in earnings. That was a sobering thought. But what's your view?
Yeah, so, my view is that let's look at where the rest of the world is, or rest of at least Asia is, with respect to earnings. And I'm talking about calendar 26 next year, consensus earnings estimates. Korea, 17%. Taiwan, China, 16%. We're between 12 and 15%, depending who you talk to. So I think those markets are trading at half the valuation of where India is. And they've got, if not the same, but a higher earnings growth for at least next calendar year. So if you look at those numbers, frankly, if you were sitting outside taking a decision in terms of allocating assets, where would you rather put your money? So that's one. Secondly, if you even look at just the absolute performance year to date in dollar terms, Korea is up a whopping 54%. Taiwan's up 25%. China's up 38%. And as Prashant just said, we're up literally 1% in dollar terms. So I think to expect FIs or FPIs to come back anytime soon would be a bit of a struggle. With respect to what you said about earnings growth improving, the big hope trade here is that GST 2.0 will actually help significantly improve earnings for the second half of the year. I personally wish that happens. And if not, I think we will have a systemic problem on how to revive the broader economy.
We take that point. And so, be that as it may for the markets and the overall earnings, etc., we're here to look at individual sectors and opportunities where one can deploy money and, make it irrespective of where the institutional flow is coming from. Financials is one space that people have been incrementally positive on. In fact, for a while, they say that if the GDP has to improve, if things have to look a lot better, financials is one space which is offering that sort of comfort. And in that also, I'm looking at a couple of these individual names. Northern Arc, something that Prashant spoke about in terms of volume gainers. It's up 5%. There were a couple of brokerage initiations over the weekend. We had ICICI Securities believing that the company trades at sub 1-time book, deserves to trade at 2 times at least. And we have DAM Capital expecting a 39% CAGR over the next couple of years for this counter. So, Gautam, while the overall market earnings are expected to grow between 12 to 15%, there are individual pockets where growth of over 30%, and in this case, 39% is expected.
Yeah, no, I take that. But I still think that this reform in GST really is going to be the key to broaden the earnings growth. And if that doesn't pick up for whatever reason, then like I said, we have a problem. So it impacts everything further down. So somebody asked me the other day, isn't this going to be great for cement companies? I said, well, cement is a B2B business. So it's great for people who are using cement, but that doesn't necessarily translate into lower, for example, real estate costs for people looking at buying a home. But when you look at the B2C businesses or B2C products that have now gone to 5% or even 0%, that's really what I see the big pickup coming. And frankly, if that's going to result in savings for individuals and that money gets plowed back in some other sector into the economy, that's, I think, when we'll see the pickup in financials. I think it's a little early to start betting so strongly on financials, unless the DAM Capital note that you're referring to does talk about the full impact of GST being morphed into a pickup for that NBFC.
Right. And so in that case, what other sectors are you betting on? If it's GST, then obviously the intuitive ones are consumer staples, some of the auto names which stand to benefit the most. And as we move into the festive season, what are your thoughts here?
I think white goods, automobiles, again, it's a hope trade, as I said, and the fact that people will end up, buying these a lot stronger than they ever did before. So I was talking to a bunch of automobile dealers over the past about few weeks after the GST announcements, and they really had, were upset about the fact that the effective date is September 22nd because most of their customers basically are holding off buying cars. So this should be a huge positive, I think. Frankly, I'm a big fan of this GST 2.0, and I think that will significantly help improve economic growth in the country and bring consumption back. But like I said, it's early days. Let's wait to see how this pans out. We'll know so in the next 5 to 6 weeks.